Hey everyone, welcome to the KE Report and another daily editorial as we are going to be talking about the gold and US dollar strength that we have seen, especially early on this year, as well as moving over to all these comments around silver and the possible deficit that silver could be in when you combine all the different factors that use silver. We are chatting right now with Jeff Christian, managing partner at the CPM Group. Jeff, first, let's talk about the strength in the US dollar. Look, the US dollar has been moving almost straight up since October, where it was right around 100 on the dollar index. Now we're right around 110. And again, it's been a persistent rise in the dollar. But in the face of that rise, we have seen some stability in the precious metals prices. Gold isn't exactly rising, but it has been more or less choppy sideways. Silver has been extra choppy, but also mostly sideways. Jeff, how do you view what's going on in these two asset classes, which many people think are usually inversely correlated? It doesn't seem like the US dollar, the strength there is having much impact on the precious metals prices.
Right. The dollar and gold and silver are all reacting to a different independent variable. And the reality is that, you know, people who think that gold trades against the dollar, that belief is not supported by data. So 2/3 of the time, gold is not moving in the opposite direction of the dollar. But what's happening now and what's happened in, the last 2, 3 months is that when investors anywhere in the world are worried about the political environment, the economic outlook, or the financial market stability, they look for secure places to park their money. And the most secure places are the US dollar, US treasuries, gold, and silver. And so when you get into an economic and political environment such as we have now, with greater uncertainty about the political and economic outlook than possibly since World War II, when you get into this environment with incredibly high uncertainty and nervousness on the part of what comes next, people buy gold and silver and park money in the dollar. So what you're seeing is all of them are very strong. Gold has been consolidating over the last 2 or 3 months at record levels. The price of gold above $2,500 did not occur until the second half of last year. We're at record levels of gold, $2,686 as we speak. We're at record levels for gold. We're at very high levels for silver, $30, $31, $32. And we're at very high levels for the dollar. And that reflects this tremendous nervousness on the part of investors worldwide. And when I say investors, I mean investors, and in the case of gold, central banks.
Well, Jeff, to that point, central banks were big purchasers of gold the last couple of years. I think sometimes that gets a little inflated, but they're definitely in the market buying. There's been a big movement in the West to buy gold, physical and even in electronic form, and definitely in the East, a huge amount of buying in the physical form. What do you think the main catalyst for gold will be in 2025? What is the CPM Group's basic outlook for the gold price over the course of this year, and how do you think things will trend?
We're looking for gold prices to rise and to make new record highs on both a annual average basis in 2025 and on an intraday basis in 2025. We think that the price will rise because of stronger investment demand. We expect investors to buy even more gold this year than they bought last year. And investors, in turn, the investment demand will be stimulated by these economic and political concerns. There will be periods of time when those concerns dissipate and the prices come off a little bit. But by and large, we think that the world is moving into a much more uncertain and potentially treacherous time than any time since World War II. I mean, and it's not just the United States. Obviously, the United States is very important. It's the largest economy. It's the largest military country. It has tremendous resources. It has tremendous power. 60% of central bank monetary reserves are denominated in US dollars. So you've got the US is important and it's very much causing nervousness around the world, but you're seeing the same sort of political instability and financial and economic problems everywhere else. And everywhere else doesn't have the US treasuries and US dollar as their currency. The US treasuries are considered the least risky financial asset in the world, surpassed perhaps only by gold and silver because they are nobody's liabilities. So you look at the debt burden in the United States, federal debt burden, private corporations and individual debt burden, it's enormous. But if you look at it around the world, it's even greater. And those things don't have the credit worthiness of the US dollar, the US Treasury, or gold or silver.
Jeff, how have you seen Western investors positioning themselves in gold now? Have you noticed any changes as we ended last year and moved into 2025?
Well, one of the things that confuses us is we keep hearing about how institutional investors in North America have not been involved in gold and haven't been part of the gold thing. We've seen gold demand rise on a global basis last year, Asia, Europe, in North America and elsewhere too. And we've been seeing institutional investors and high net worth individuals and family offices in North America buying gold. And when I keep hearing that the North American markets haven't been participating in this gold buying spree, we don't see that. We see them being active buyers and we see them increasing their interest. Now, US North American institutions like central banks tend to be very much more price sensitive than a lot of other investors. So they'll be more cautious as being buyers at record highs. Other investors will say, oh, the price is rising. It's at a record level. Let me jump into the market and join the fray. I want to ride that runaway train. Institutional investors in North America and central banks will say, I would rather wait until the price comes back down to 2,600 or something like that to buy. So we've seen some of that caution there, but generally speaking, we've seen more institutional investors in North America interested in gold than any time in the last half century that I've been in the market.
Well, Jeff, because you track this data so closely, I thought it might be nice to just dive into some of the things we hear and maybe parse them out. We hear that central banks are not price sensitive and they just buy at all costs. It sounds like you wouldn't agree with that statement, that they're actually more savvy than people are giving them credit for. We also get a lot of attention about China and the buying in China, and everybody makes a big point that if when China was buying earlier last year, that's what was moving the price up. Then they stopped buying, and that's why it corrected. But then they started buying again recently, and that's why it's going up. Do you put a lot of stock in comments like that about how central banks are buying versus the reality that you see, or how much of a force is China really on the gold price?
Well, on the central bank side, central banks are more price sensitive than private investors. And you have seen them pull back from buying as much this year or in 2024 as they had been buying in 2022, 2023. So there is price sensitivity on the part of central banks. We've actually seen a couple central banks that were buyers in 21, 22, 23, selling gold in 2024. In terms of China, it's, the problem is a matter of degrees. China is very important. It's the second largest economy. It's an economy with a long-term, multi-century history of using gold as a store of value and an alternative currency. It has a non-convertible currency, the yuan, that doesn't have the guarantees and the credit worthiness of, say, the US dollar. So, and it has an economy that is suffering from a variety of problems that the government is working hard to try to rectify. And it has a political system that also is probably more shaky than it has been in the last 80 years, truth be told. So you've got a lot of people and in companies in China who are saying this is a good time to have money in gold and in silver. And in fact, to their credit, the Chinese government has at times recommended to citizens, you should have some of your wealth in gold because they feel that it helps create a sense of stability and security on the part of Chinese citizens if some of their wealth is in gold, which is their traditional store of value for centuries. So the government says, yeah, why don't you buy some gold? And then you can sleep better at night. So China's important. Now, to say China's important is true. Then you get these guys who inflate it and they say, oh, China is the engine. Yeah, well, it's not the engine. India is very important too. And you've seen a lot of demand for gold and silver in India over the past year or so. China is important, but it gets blown out of proportion by promoters.
Yeah, I kind of agree with you on that, Jeff, because I have heard just how important China is. And I do think China is important for, in a way, setting a floor on prices, not just for gold, but for a wide range of commodities. But too many times I've heard China's going to drive this, China's going to drive this. And quite frankly, it's just too narrow of a narrative, I think, of what actually drives a lot of different commodities prices. But what about silver then? Is silver getting more accepted in a sense by investors as that stability that gold provides?
Yeah, silver doesn't have all of the glory that gold has in the minds of many investors, but it has a lot of it. And it traditionally has been there. And that's true in China, it's true in the United States, North America, Europe, Latin America. And because of the price differential per unit, a lot of people who cannot afford an ounce of gold can afford several ounces of silver. And so you see silver as having a greater retail allure than gold because people who don't have $3,000 to buy an ounce of gold can buy, $100 worth of silver and build their diversification that way. So it's very important. We've seen an increase in silver demand by investors in 2024, a sharp increase. We expect a even larger increase in 2025, partly because we think that silver is perhaps more attractive in terms of capital appreciation. And again, it's more attractive to those smaller investors who can't necessarily say, oh, I'm going to buy X ounces of gold, but they can buy X ounces of silver. So our expectation is that silver may outperform gold over the course of 2025 for those and other reasons.
Well, Jeff, when we look at silver, we often hear in the industry that there is a supply deficit. And we've talked about this in prior shows with you, but I really think this is one of the big disconnects in the entire sector as to how people calculate whether something's in a deficit or not. And it really comes down to the mixing of investment demand with fabrication demand to get to the deficit outcome versus keeping them separate. So I'd love to get your thoughts on why you segregate them in two different buckets when you do the CPM research versus how some people present it as a big deficit in the marketplace.
Okay. Well, first let's talk about the commodities research 101, which is a surplus and a deficit is total supply, mine production and scrap, less fabrication demand equals a surplus or deficit. And that's how commodities are done. And you can look at any commodity and basically that's the model. And that's what we do. You keep investment demand separate. Now, that's not to say that we are saying investment demand is not important. It's a separate line item in our table. And it's segregated from fabrication demand for several reasons. One is that when an investor buys gold or silver, he keeps it in gold or silver form. Let's talk about silver. Keeps it in refined silver form in bars or coins that can be resold at a moment's notice. When a fabricator buys silver, it uses that in a product that it's manufacturing. In a car, you might have maybe $100 worth of silver in a car, right? Or in a electronic component where you've got pennies worth of silver in the thing, or solar panels, or their fabrication in jewelry and silverware where you have a higher silver value. But for many products, the silver is in manufactured form. It's no longer readily saleable. And people aren't going to say, oh, the price of silver has risen to $33. Let me go up on the roof, take down those solar panels that cost a multiple of the silver content and have them refined for the silver. So fabrication demand has completely different economics and mechanics and price responses than do investment demand. Investors don't have to be in the market. They don't have a factory that they have to feed raw materials into. They can say, I'm going to go away from silver for the next 15 years, and then I'm going to come back intensely. And in fact, as a group, that's what investors have done. So you want to keep investment demand separate because it responds to prices differently. It affects prices much more importantly. You want to know what fabrication demand is doing because it's important and it helps to build what that floor price is for silver. But you also want to know what investment demand is doing, quite distinct from silver, from fabrication demand. And we have people who say, well, you're ignoring investment demand. I say, no, we're paying attention to investment demand. That's why we segregate it, because we want to know, and our investor clients want to know, they don't want to invest in a market that's, quote, in deficit because investors are buying silver. They want to invest in a market that has a tight supply-demand balance, tight balance between supply and fabrication demand. So there's a fundamental or primary tightness in that market. That's what interests informed investors. So our investors want to know, tell me what markets are tight on that basis, classical commodities research basis. Those are the ones I'm interested in. So that's why we do it. And it's not that we're deprecating or ignoring investment demand. We're elevating it to a higher pedestal so that people can focus on investment demand and know exactly what's going on in the silver market. Now, in terms of people having added investment demand to fabrication demand, this was done in the gold and silver markets in the 1990s by a group that was supplying data to two institutions that were in the business of promoting gold and silver investment products. And those institutions didn't like CPM Group's data because we weren't bullish enough. So they went and they found somebody who would say, I will add dummy variables for investment demand to fabrication demand. And instead of showing a surplus, I'm going to show these humongous deficits, right? So the whole idea of adding investment demand to fabrication demand and coming up with a deficit was created in order to give ammunition to a company that was in the business of promoting investment demand to silver demand to investors, right? Very disingenuous. It's sort of like the silver squeeze in 2021.
You know what, Jeff, just trying to make the numbers work for what the narrative is, right? I get that. That's just what some people do. But I was at a talk that you gave in Vancouver recently, more at the end of the year, where you were breaking down this investment demand and how important it was. And a key driver recently to some of the investment demand is more the nuance, or not creation, but increased interest in coins from the investment demand. Explain how much coin interest, coin growth has contributed to investment demand, and where you see this playing out.
Coin demand is all over the place. I mean, it's very heavy in the United States and Canada, but you also see it in Latin America, Europe, and various parts of Asia. Different countries will use different coins, but like in Southeast Asia, there are all kinds of domestically produced currencies, if you will, or quasi-currencies using silver and gold and they're actually used in some countries in transactions. But it's really coins, and the era of modern silver bullion coins issued by governments really started in the mid 1980s. And I'm very proud of the fact that I was involved with the Royal Canadian Mint in creating the silver maple leaf. And I was also very much involved with the US Mint, with the Silver Eagle, and with the Perth Mint, with its coins, and the Austrian Mint with the Philharmonic gold and silver coins back then, too. But you started seeing silver bullion coins created by national mints in the mid 1980s. And it's become the preferred way for a lot of people to buy silver. It's smaller units. You pay a higher premium. They're pretty, yeah, and they're divisible. So if you're buying these metals because you think that if you're, I guess, what they call a stacker, there could be a time when your currency or international currencies are not acceptable. You have precious metals to buy things to live with. And if that's the case, an ounce of silver will be much more utilitarian than an ounce of gold. In that kind of environment, let's say that the gold price goes to $5,000 an ounce and the silver price goes to $100 an ounce, right? Or something like that. And in that kind of environment, a 1 ounce silver coin is much more useful. So from that perspective, it's there. There used to be, and I think there still are in some jurisdictions, tax advantages. If you had a 1,000 ounce silver bar and the price of silver was $5 an ounce, it was $5,000, you sold it, and no one had to report that sale to the IRS. Once the silver price went over $10 an ounce, that 1,000 ounce silver bar was worth more than $10,000, and you selling that bar became a taxable event that the buyer, the coin dealer who was buying it from you, had to report to the IRS. So you would pay taxes on it. And so around the time that silver passed $10, which was, say, 2007 to 2011, you started seeing people do two things. One was they were taking their 1,000 ounce bars that they had bought earlier and selling them and buying ETFs because of a variety of reasons, including this whole tax issue. But you also saw them not selling their 1,000 ounce bars, swapping them for silver coins, official silver coins, right? So you saw an investor saying, okay, I've got a 1,000 ounce bar. Let's say it's worth $20,000. I want to buy 1,000 ounces of silver coins. Now they have a premium, so I'm not going to get 1,000 ounces. I'm going to get maybe 900 or 950 ounces, but it's a swap. It's not a sale. It's not taxable. Now I have coins. I can sell them in 100 ounce or 10 ounce lots, and I'm below the tax reporting threshold. And I hate to say it, but some people actually did that in order to avoid paying taxes on ultimate silver sales. So there were a variety of reasons over the last 40 years for silver coins to become very attractive. We had a client in the very nice elderly lady. Her husband had built a company. He had sold it. They had a lot of money. He died. And someone came to her and said, you should be buying silver. Silver was probably about $7, $6 an ounce at the time. You should be buying silver. And she listened to him and she said, this is great. And he said, and you should be buying silver coins. And she wanted to buy $50 million worth of silver. And, I don't think there were $50 million worth of silver coins in existence then, because the eagle and the maple leaf were just being created. The silver eagle, silver maple leaf were just being created. So she wanted to buy, and I got a call from somebody involved in the transaction. Please talk to her, because, she could buy 100 or 1,000 coins and have them in a safe at her home. But the rest of the silver should be bought in 1,000 ounce bars, left in depositories where it can be resold without being reassayed. And there's no question about the provenance and the purity of that silver. So silver coins have a lot of advantages, and they become very attractive. and you've got probably 2 billion ounces of silver in coin form now around the world.
Well, Jeff, one other phenomenon that I want you to get you to weigh in on is we've been hearing a little bit in the marketplace about a silver stockout, and the idea being that there's a divergence between the COMEX price of gold and the LBMA, or the London spot price of gold. So there's an arbitrage there, and people are pointing to this as another thing where supply is so limited that there's a deficit, that there's going to be another squeeze in silver due to this silver stockout. Could you comment on the comments we're hearing in the marketplace on this?
Yeah. First off, the idea, people say, well, I've never heard of a stockout. Well, that's because the term was just created this month, and it's really kind of crazy. There has been an arbitrage for gold as well as silver between New York and London and New York and other trading centers. So what you're seeing is people buying gold and silver in London and shipping it to the New York market, which is the New York area market. And, the gold goes by plane. So when you buy the gold in London, 2, 3 days later, it shows up in New York. The silver goes by ship. And most of those ships now go into Canada, offload, and then they truck the silver down into the New York market. It has to do with the logistics of US ports versus Canadian ports. So there's a lot of silver en route to New York. As a result, you've seen a decline in London inventories, and you're seeing some increase in US New York inventories, which will increase further as this silver arrives. And again, silver promoters they've taken a playbook from the Wall Street silver squeeze scam of 2021. They're trying to make people think that the world's running out of refined bullion. And you could get to a situation where there simply isn't any silver left in London that isn't attached to silver ETFs. It's highly unlikely that's going to happen. And it all has to do with an arbitrage, the spread between London prices and New York prices. That arbitrage goes back and forth. It's gotten very wide recently, partly because some traders are moving silver into the United States because there is strong demand, fabrication demand, as well as investment demand in the United States. Speculators are buying silver and gold because they think that Trump is going to impose universal tariffs on everything, including gold and silver. And, you want to have your gold and silver in New York, not in London, to avoid paying those tariffs. And you'll get a premium for your metal if it's stored in North America. So there's this whole weird thing. It doesn't hold up to logic, and it flies in the face of the fact that arbitrage goes back and forth, right? In 2007, 2008, 2009, with the creation of the ETFs, many of which stored their gold or silver in London, you saw silver coming out of New York and going into London. And there was the arbitrage, the spread between New York and London was such that you could profitably take delivery of silver in the New York market and ship it to London. Now it's going the other way. If you were to get to a point where London was, quote, running out of, freely available silver, the arbitrage would flip and people would ship it back because it'd be profitable to do that. Yeah, it's just a function of the mechanics of the market on a short-term basis. It's not the kind of thing that investors should be fooled into thinking is going to drive the silver price sharply higher on a permanent basis.
Okay. So no silver squeeze, at least on that front, coming. But Jeff, you do have to admit that's a pretty cool saying, that silver stockout. I do like that term. All right, Jeff, we'll wrap it up here. Thank you for your insights. Again, first on that gold and US dollar strength, as well as now silver, the different factors at play and how you view that investment demand, which, look, investment demand does continue to be, I agree with you, that the major driver in prices, at least in the short term. Again, Jeff Christian, managing partner at the CPM Group. Jeff, thanks for taking time with us today.
Guys, it's always a pleasure.